Credit cards feel simple. You swipe, you tap, you pay later. But here's the part most people miss. One small mistake can quietly turn that convenience into a long-term trap. Let's slow this down and actually look at how credit cards really work and why they help some people but hurt most others. Most people think the problem with credit cards is overspending. That sounds reasonable, but it's incomplete. The real risk isn't the swipe, it's what happens after. And that part is rarely explained clearly. So first, what is a credit card? At its core, a credit card is a short-term loan. Every time you use it, the bank pays on your behalf. You're borrowing money with a promise to pay it back later. Simple so far. The key detail is this. Credit cards are designed to feel like money, but they behave like debt. And if you forget that, even briefly, the math starts working against you. Each month, your card creates a statement. That statement shows how much you borrowed. You're then given a short window, usually around 20 to 25 days, to pay it back. If you pay the full amount on time, something interesting happens. You pay zero interest. None. In that case, the credit card actually works in your favor. You use the bank's money temporarily for free. That's the upside people talk about. But if you don't pay the full amount, the system flips. The remaining balance starts accumulating interest, and credit card interest is not gentle. It's among the highest interest rates most people will ever face. Here's where the trap forms. Interest is calculated daily, but added monthly. That means the longer the balance sits there, the more it compounds. Not loudly, quietly. This is the part most people ignore. They focus on the minimum payment, but the minimum payment is designed to keep the balance alive. When you pay only the minimum payment, most of your money goes towards interest, not the original amount you borrowed. So the debt shrinks very slowly, sometimes over years. This is why a small purchase can end up costing much more than expected. Not because you're careless, but because the system is optimized for patience, not speed. Now, let's clear up a few misconceptions. First, credit cards don't automatically mean debt. Used correctly, they're just tools. Used incorrectly, they become expensive ones. Second misconception, rewards make spending worth it. That's not quite right. Cashback and points feel like gains, but they're small compared to interest. A single missed payment can erase months of rewards. Third misconception, having a balance improves your credit score. It doesn't. What helps your credit score is paying on time and keeping your usage low, not paying interest. Banks don't reward you for carrying debt. They reward you for reliability. That's an important distinction. So, here's the counterintuitive insight. The best credit card user is someone who borrows often but owes nothing by the end of the month. Credit helps when you pay in full every cycle. Credit hurts when balances linger. The difference isn't income or intelligence, it's timing. In practice, this means treating your credit card like a delayed debit card. Only spend what you already have. Use the delay for convenience, but not for financing your lifestyle. If you ever can't pay the full balance, that's a signal, not a failure. It's a signal to slow down, reassess, and reduce usage until the system is back in your control. Credit cards aren't evil, they're precise. They do exactly what they're designed to do. Once you understand the mechanics, the fear disappears, and so does the trap. If this helped clarify how credit cards actually work, subscribe for more calm, clear breakdowns like this. And if you want to go deeper, watch the next video on how interest rates quietly shape your financial life. Think clearly, build wealth.